Part 2, Technical Analysis. My experiences trading stocks, cryptocurrencies, forex, commodities, and derivatives have shown me that these strategies, indicators, setups, and more apply to almost any asset class. Chapter 23, Charts Expanded. We looked at reading stock charts earlier. Now, let's expand on the gateway into technical analysis. Once you fluidly read and manipulate stock charts, you'll be ready to explore setups and indicators. Now that you're familiar with dividends, which show up in Yahoo Finance charts as big D's, let's look at stock splits, which show up as the bottom of charts as subtle S's. A company may split its stock when it wants to lower its per share price for small investors, reward executives with more shares before new financing rounds, etc. The principle behind these splits is existing shareholders' positions are multiplied by X shares per existing share, and the stock price is divided by that same number X. For instance, say a company stock trades at $100 and you own 10 shares of the company. A 2-to-1 split would reward you with 20 shares of a stock, and the company's trading price would go to $50. The number of shares you own doubles, and the price of the stock is halved. Stock splits like these and reverse splits, which we'll explore soon, affect all market shareholders by changing the number of tradable shares available in the underlying company. When a company decides to split its stock, its board of directors picks a split ratio. In normal forward stock split, a company divides its stock price by the split ratio while simultaneously multiplying the number of shares outstanding by the split ratio in shareholder accounts. For more information, see stock registrars in Chapter 37. All existing shareholders have their position size multiplied by the split ratio, while the price of each share decreases by the same factor to maintain the same overall value. For example, in a 2-to-1 forward split, a $100 stock turns into a $50 stock, and every share you own turns into 2. The overall value of the company does not change, and your position in the company is not diluted since all outstanding shares were multiplied. Existing positions are worth the same amount of cash, but stock splits, especially with more expensive stocks, allow more investors to purchase the stock since its price point is now much more accessible. Additionally, split stocks are individually worth less, but more floating shares in the marketplace increases liquidity. This increased float will make it more difficult for the stock to move quickly intraday. However, this effect will be minimal when the initial float is already low. A reverse split, in contrast, increases the price of a stock by decreasing the circulating supply of shares in a company. For example, let's say you own 100 shares of a stock that costs $1. Suddenly, the company issues a 10-to-1 reverse split, and your 100 shares turn into 10 shares, while the stock price multiplies from $1 to $10. You should be especially skeptical when you see a company issue a reverse split. While stock splits provide increased market liquidity by giving investors more shares to buy and sell in the trading day, reverse splits decrease the number of shares in a company and artificially increase its stock price. This lowers the number of shares tradable intraday and generally hurts liquidity and spreads. Generally, very cheap stocks, sometimes fractions of a penny, use reverse splits to stay listed on exchanges that mandate minimum prices. Additionally, many companies must perform reverse splits to increase their price per share up to a minimum quota to stay listed on an exchange, as most major U.S. exchanges will delist stocks that consistently fall below a minimum price. Some stocks also use reverse splits to falsely make their stock look more valuable to investors. In theory, stock splits and reverse stock splits do not change the amount of principal in your current position. However, forward stock splits generally indicate good company health in practice since they show company tailoring their stock to retail investors. Alternatively, reverse splits do not technically change or destroy a stock's market value, but they create poor public sentiment and decrease liquidity in practice. If you're actively trading, you can watch out for recent splits and use them to predict where a stock might move based on its price before the split. Even for long-term investments, you can use recent splits to consider the short-term value of an enterprise. Yahoo Finance automatically adjusts stock charts and corresponding prices to account for stock splits, saving you from calculating historic price levels to analyze a company before stock splits. However, you should always notice splits as, especially in night and noon trading, they can cause immediate rapid price variations in markets looking at newly priced companies. In the long term, you can use stock charts to see how volatile a company has acted historically. This volatility can help you understand the risk of a new position rapidly moving up or down given its history of consistency. Stocks with consistent growth trends may carry risks lower risk than emerging stocks with much more volatility. For example, let's look at Walmart Inc. from 1985 to today. And we see a historic graph of Walmart, pretty consistent long-term growth with a pretty huge run-up in 1990s, 2000, around the bubble, and then pretty flat growth until about 2010, and then they started to take off again. Walmart has gone through many stock splits to keep its price point low for investors. Furthermore, we see consistent dividend payments throughout Walmart's history. In Q4 2018, Walmart's forward dividend is 2.13%, or $2.08 for each share, which is currently just under $97. Moving past this solid diverse dividend and stock split history, we see that Walmart consistently went up in the long term as the company grew to expand both corporate profits and shareholder distributions. However, notice that Walmart has gone through significantly extended sideways movements, slightly bearish periods, subsequently large bull runs from approximately 1993 to 2000 and 2004 to 2014, and fast price spikes and drops in the past half decade. To decide if a company may be a good long-term investment, you can assess its historic volatility and general historical trend movements. Generally, you want to see consistent growth that you expect to continue for the next 50 years because of strong fundamental business practices if you are investing in your retirement accounts. For the extremely long term, you want to essentially see anything but GE. For reference, here is General Electric Company from 1985 to today. And we see a huge run up, 2000, then a giant bust, and then a little bit of a bounce in the 03, and then a crash in 08 that just crushed them, and then a big back run up, and slide back down. From 1985 to 2001, GE would have been a staggering investment that turned $2.50 into $50, considering capital appreciation exclusively, completely ignoring dividends, which yielded almost 12% in some years, a 19,000% gain overall, approximately 20% annual gain compounded for 16 years. With this success, it is no wonder that the company performed 4 forward splits during this time period to keep their stock affordable for the average investor. Yet, more recently, GE has seen extreme boom and bust cycles, shredding shareholder value and corporate market capitalization in rapid downturns followed by calm or bull runs. Considering this, it is important to check your long-term picks periodically to assess growth and potentially take profits off the table. With that said, General Electric is a dominant established corporation in its many profitable industries, with revenues exceeding $120 billion in 2017. Stocks like GE might lose some profits in stock value during market downturns, but they still stand as potential buys to later sell at new highs through swing trading. In general, try not to lose money, so when everyone else says to buy, and buy when everyone else sells. Anyway, let's get back to Walmart Inc. Say grocery stores are your favorite investment industry ever, and you want to invest in Walmart for the long run after seeing their strong historical performance. Great news for you. Stocks like WMT are much easier to time than overall market macroeconomic influence index funds. The first step to analyzing your entry point is to zoom in. You can increase trading profits by primarily relying on short-term price action, indicators, technical setups for 9 to noon trading, order entries, and order exits, which we'll explore indicators, setups, and more throughout part 2. For long-term picks, it is great to establish your interest in a stock based on long-term trends and company fundamentals, but you can usually buy a stock for less or sell it for more by looking at short-term patterns. If you spend the time to analyze both these short-term movements and long-term setups, you can consistently invest in opportune entry and exit points. For 9 to noon trading, these setups are the entire basis of your profits. Zooming into WMT's 5-year chart, notice that the stock has the miss of a bull run. Then we see it goes up a lot. We can also see large red volume candles in the early 2008 pullback from $110 to the high $80. Such volume bars, like many other indicators coming soon, are great indicators of price movement. However, you should rarely base an entire position on one indicator. Instead, it is ideal to combine the many strategies coming soon with corporate fundamentals, personal insights, and market trends that find the best picks available. Since the market is currently more volatile than normal, as shown by the CBOE Volatility Index, VIX, we might expect a more rapid short-term price movement in the overall market, including Walmart Inc., a well-established, thickly traded corporation. The VIX measures the 30-day expected volatility of the S&P 500 index by using options and subsequent S&P 500 options contract technical changes to produce a tradable index value. The index has accurately measured the historical volatility of the S&P 500 market volatility as shown below. And then we see the S&P going uptrend over time, and then as it goes down and has really, really volatile downtrends and crashes, that's when the VIX has its highest values underneath it. From highest to lowest final return, we see the S&P 500 and the VIX, and those are just values. With little more to analyze than Walmart, we can change our chart's weekly candlesticks to daily candlesticks. This shorter data set demonstrates a somewhat inflated price emerging as Walmart trends upward. Without indicators or trend lines, we are trading blind with this chart and only able to see a somewhat inflated jump after August and increasing selling volume in recent weeks. We can keep zooming into this chart as much as we want to analyze it, but at a certain point, too much analysis and short-term bias can blind you from macro movements. Looking too closely at a stock's short-term movements can be counterproductive when you make a long-term trade with a larger, established, thickly traded, publicly followed stock. These stocks generally make meager percent change movements compared to 9 to noon stocks because they have higher floats that prove tough to move without large volume alongside well-established value levels. Float represents the number of outstanding shares available for immediate trading, ignoring insider shares, employee stock plans, and other long-term ownership plans. So, even though Walmart probably will not double the number of stores they operate overnight, you can still take advantage of such long-term growth in your retirement or overarching savings plan. Zooming into the hourly candle chart on Walmart, we see the following, and then it shows the chart. Looking at this, little new information or candlestick setups appear to base new positions on, but there have been some good setups to analyze, such as a few small head and shoulder setups. In fact, this entire weekly movement may unfold to be a head and shoulder setup soon. We'll talk more about head and shoulder setups and other candlestick-based setups in chapter 29 and 30. We really need indicators to trade this chart, and without this information, we can only see a ton of bars on top of price movements shown zoomed out earlier. We will explore such indicators in chapter 31 and 32. The pink bars that Yahoo Finance shows represent extended hours price movements outside of the 9:30 to 4 a.m. to 4 p.m. in New York time. Yahoo Finance does not have the most recent aftermarket data since it relies partially on delayed data, but your broker-provided charting service should have all possible up-to-date information. In a larger stock like Walmart, intraday price movements are usually small unless huge news surfaces. For example, the August 16, 2018 third quarter earnings report caused a huge spike shown above after a 6.61% earnings per share surprise. In 9 to noon trading, these pre-market movements are crucial to identify potential high flyers, and we will discuss later. Additionally, we'll almost exclusively use extremely zoomed in 1 minute or 5 minute candlesticks, since active trading is much more specific than anything that holds a position for years, and analytical than holding a position for years. Always look for opportunities to time a position and secure the best possible buy and sell prices. Going back to the August 16th movement in Walmart, we see one of the stock's largest single-day price changes in 2018. After this run-up, the stock tumbled down slowly for months, so this movement proved to be an overreaction to news. We can take advantage of this phenomenon in a wide range of trading, as many people freak out in the market and allow you to buy or sell at extreme prices, which you can identify with technical analysis. Participants buy based on news rather than fundamentals and technicals, acting impulsively on emotions and extreme announcements to create fast movements, sometimes followed by equally speedy reversals. You can overcome these tendencies and improve your trade consistency by buying undervalued stocks that you identify with technical analysis. Underlying corporate assets change very slowly, but public perception changes rapidly. Take advantage of big downward opportunities in a corporation you deem valuable and dare to buy when others sell, as long as you understand why others are selling and acknowledge the risk of a trade with a hard stop loss. Catalysts or institutional sell-offs and buy-ins often trigger big movements like these. If a company rockets to much higher than you think it is worth, then you can take advantage of technical analysis tools like Bollinger Band in Chapter 32 and your own principles to short an overextended stock. However, never base too much judgment on just one factor or indicator. Rather, look for a beautiful synthesis of the coming technical indicators along with catalysts such as market-moving news that you can easily find in the news feed available when scrolling down on any stock summary in Yahoo Finance. Most importantly, know when to admit that you're wrong on a position and take seemingly unavoidable losses before they compound and grow. It is also okay to miss a little upside by getting in or out movements too early, as long as you participate in the overall movement you expect from a position. Technical indicators can help you buy and sell close to possible highs and lows in your given position time frame, but indicators like stochastics in Chapter 32 can also expose hesitancy and price uncertainty in stocks. Uncertain markets are certain to take you down with them. Quarterly reports, 10Qs, and annual reports, 10Ks, are much more important when investing in Walmart or any other company for the long term. I would not dream of touching these sacred documents with a 9 to noon stock. Companies account for their financials publicly in these reports, allowing Yahoo Finance to create the Amazing Financials tab that consolidates the past 4 years of a company's financial performance. You can analyze core metrics in these reports to find one of the most important long-term growth factors: money. To find a full corporate report, look up any company's investor relations webpage. Look for revenue, income, gross profits, earnings, margin, costs, debts, assets, liabilities, and more. Here's how Yahoo Finance's stock tabs currently look. These tabs are portals to the long-term stock analysis alongside annual and quarterly reports. Then we see all the tabs in the financials tab with income statement, balance sheets, and cash flow. You usually want to see companies grow their revenues, margins, profits, and assets over time while responsibly managing debts and other liabilities. Additionally, make sure any income influx and gross profits support a stock's market capitalization. To calculate the book value of a company, you can use its balance sheet given under the Financials tab. Simply subtract total liabilities from all assets and compare your results to the market capitalization, or divide the number by the total shares outstanding for a per share book value. Yahoo Finance makes book price calculation even easier for you by using its financial data to calculate a stock's book price under the Statistics tab. By using the Statistics tab, we can see the following standout statistics among others. Book value. WMT's book value per share based on its most recent quarterly report is $24.62. The company currently trades at significant multiples of its book value, showing us that there is more to the value of Walmart Inc. than its accounting value according to the open market. Float. Walmart has around 1.43 billion tradable shares, making it tough to very rapidly move the stock price. For 9 to noon trading, prioritize stocks with low floats. A stock with a small float, say 4 million shares outstanding, will move significantly faster as investors compete to buy shares from the limited sellers, especially after a market catalyst. With 9 to noon stocks, look for low floats to maximize potential returns, as the market can quickly buy up a stock supply, driving its prices up quickly. Profit margin. Higher is better, but not completely comparable between different companies. Some industries have innately lower and higher margins with different cash flows. Dividend payout ratio. If a stock pays a dividend, this statistic calculates the percentage of all earnings paid to you and other shareholders in dividends. For newer companies, expect this number to be low since money is constantly reinvested to grow the business. For well-established businesses, look for higher payout ratios that show a corporation returning its profits to shareholders. WMT has consistently increased its dividend yield for decades, and its current payout ratio is 117.71%. Without looking at the company's accounting methods, we can assume that Walmart Inc. must either increase earnings to supplement this dividend, use cash reserves and retained earnings to pay shareholders, or decrease their dividend. Percent of shares outstanding and float short. The percent of all outstanding shares and float currently shorted for Walmart is $1.35 and 0.66% respectively. High short interest shows that many players in the market think a stock will go down, while low short interest reflects bullish sentiments. If a stock has a high percentage of its shares shorted, you can see many short shareholders either panic and buy back their shorted shares or exit their position because of automatic stop losses and upward swings. Short squeezes are more common in 9 to noon stocks, with extremely large percent increases in which pressures short sellers to cover increasing losses early in the market, further causing prices to squeeze up. We'll explore 9 to noon stocks in chapter 36. Other times, brokers may automatically cover short client shares due to individual brokerage shorting rules and periods. Check with your broker from chapter 37. The short ratio statistic 2.04 for Walmart can also help you judge shorted shares. This represents the number of shares sold divided by the average daily volume, showing the number of average trading days it would take for all short sellers to cover their position. Buy the rumors and sell the news for steady gains. Beyond the accounting, financials, annual reports specifically can give you great insights into a company, especially if you know little about their business. These reports, although sometimes long, generally walk you through exactly what a company does to make money alongside how they view their long-term presence in the marketplace. They report on a company's competition, risk factors, founding principles, sustainability, investments and acquisitions, and their performance, expansion plans, business operations, underlying business model, logistical backend, principles and subordinate businesses, reliance on consumer credit cycles, research and improvement plans, in other words, development plans, number of employees, employee relations, executives and their compensation, and physical and intellectual property specifics to learn about a potential advantage compared to other businesses in the same market, perhaps property that raises the barrier to entry for to-be competitors. You may not need to read an annual report about companies you already know a lot about, but these documents can significantly help you understand a new, potentially higher returning stock. To find these annual reports, simply look up company name annual report. The SEC also keeps copies of 10-Ks in the public domain. Try to read a corporation's most recent annual report, as it will contain insights, financials, and plans most pursuant to your investment time frame. To gain supreme insight into a company you invest in, consider attending or listening to a shareholder meeting. These meetings show a company cares for its shareholders and, now that you're a shareholder, lets you gain insight into future growth prospects. These prospects can reaffirm your position in a corporation and present new opportunities to create shareholder value through business expansion and overhead management. Not all trades will look terrific. Thankfully, there are thousands of listed stocks to look through in the U.S. markets alone. Let's continue exploring technical analysis to learn how we can better analyze current price trends. With these skills, you will surely profit more consistently than trading blindly.